Welcome, dear traders. The Jackson Hole Symposium will certainly stir up market volatility. However, it may undermine a rally on Wall Street. Market uncertainty is now high. Traders are puzzled and they do not know what to do. They abandoned hopes for a softer stance again, and the majority is now betting on a more aggressive rate hikes. And yesterday, Wall Street incurred the largest losses in 2 months. Anxiety also affected the Asian session. Trading sentiment turned out to be more bearish. So, Asian stocks were also in the red. Such a market reaction usually occurs when speculators jump to conclusions despite some clear signs that the real situation could be the opposite of the expectations. Following the release of the FOMC minutes and hawkish remarks of Fed policymakers, they have finally realized that a shift to a dovish stance will hardly take place in the near future. A rally on Wall Street was mainly fueled by overly optimistic forecasts about the possible rate cuts next year, and this is why optimism has waned rather quickly. Traders are now factoring in a more aggressive rate hikes. They expect the federal funds rate to reach 3.7%, whereas in early August the figure was 3.25%. The key rate is likely to approach the target level in March next year. The likelihood of a 75 basis point rate increase in September totals 54.5%. On the weekend, investors were sure of a 50 basis point rate hike. Thus, speculators assume that the central bank is likely to stick to monetary tightening until inflation returns to the 2% target. They believe that Jerome Powell will express the same opinion at the symposium. Yet the situation is rather controversial now. Some Fed officials warn of the risks associated with the aggressive tightening. Inflation seems to have perked. In addition, some crucial economic indicators turned out to be much weaker than expected. The yield curve measuring the spread between yields on a 2- and 10-year Treasury notes slid by 30.8 basis points, and it's signaling high risks of a recession. Curiously enough, investors still consider Powell to be a supporter of a dovish policy despite a rapid shift to a hawkish stance. For this reason, traders could be now buying the US dollar on rumors about the Fed's hawkish stance, but later they will start selling it on the news. The US dollar index breaks through new highs every day. Its rally is unfolding steadily despite the fact that the US currency is overbought. Today, the US dollar index has consolidated above 109. A strong upward movement looks likely in the near future. The index overcame another critical level. The next target level is a high of 109.29, reached on July 14. A more distant target will be the 109.77 level, a high of September 2002. As long as the US dollar is trading above 105, it will maintain a short-term uptrend. While the bulls are bracing for the symposium, inflation expectations in the United States have been growing for the fourth day in a row. By the end of the American session on a Monday, they rose to 2.57% after breaking through the July high on a Friday. Such a surge could be associated with the predictions of a more aggressive rate hikes. The dollar-yen pair halted its rise, and the pair stumbled at the resistance level of 135.50. On a Tuesday, the quotes rolled back by 0.2%, and the 10-year US Treasury yields retreated to 3%. To this end, the pair was unable to regain momentum. The pair needs to break through 137.85 in the coming weeks in order to cement a steady uptrend. It could move from today in the narrow range due to the overbought status of the US dollar. Despite a rise to a high of 137.60, it did not help the bulls to assert strength. The pair may slide into the consolidation stage on a Tuesday, fluctuating in the range of 136.80 and 137.80. In the short term, it's likely to resume growth if it climbs above 137.85. Thus, it will take some time before the pair could touch the next resistance level of 138.30. The bulls are likely to hold the upper hand as long as the greenback is trading above 136.40. If the pair drops below this level, it will hardly advance. Today, at the US PMI Manufacturing Index for August, the Richmond Manufacturing Index as well as the new home sales data for July are on tap. The economic calendar lacks any important reports that could impact the Australian dollar today. The AUD-USD pair is facing bearish pressure due to risk aversion. During the Asian session, it was trading in the downward channel around 0.6860. The quotes have already dropped below 0.6900, yet analysts assume there will be more negative drivers for the pair. The Reserve Bank of Australia may be soon forced to do a U-turn to engineer a soft landing. At the meeting scheduled for September 6, traders are expecting a 39 basis point rate hike. If this scenario does not come true, the Aussie is sure to fall. Besides, fresh macro stats on a contraction in China's economy could also put pressure on the Australian dollar. China remains Australia's largest two-way trading partner. The outlook for the AUD-USD pair remains unchanged. The peers will retain control if the pair drops below the monthly low in the range of 0.6870 and 0.6865. And this is exactly what is happening now. If so, the quotes may test the 0.6800 level and then tumble to 0.6765. Now investors are looking for clues about whether inflation has perked. Any signs of it may indicate a more favorable scenario for the US economy and the global one. Judging by the dismal situation in some markets, it's still early to count on a steady recovery. And that's all for now. Subscribe to our channel and stay up to date with the latest market news. See you soon.